We have seen a strong rally in global equities this year, but can the markets keep rallying like they have? For a deeper dive, Will Hamilton, Managing Director at Hamilton Wealth Partners, joins me now. Will, great to see you. Thank you so much for joining ausbiz.
Good to see you, Danny. Thank you. Thanks for having me.
Okay, so you guys, yourself, etc. You've been on the program saying you were pretty upbeat at the back end of last year on equities, putting money to work, but have the markets kind of got away from everyone at the moment? Have they rallied too far and too fast?
Yeah, look, I think the answer on that is yes. So I think the MSCI ACWI ex-Australia's up for 12 months about 28%. Australia's up, the ASX 200's up about 14%. The way I'm putting it is we don't have our foot on the brake, but we've definitely pulled it back on the accelerator. It was flat down. But I think that we need to get some sort of a correction, and corrections between 5 and 10% are very healthy, and we need to see that. And I think that there's been a lot out there with respect to the talk of no landing, and the fact that growth is so strong in the US. This is that also can create some issues, and I think there's some risks as well that have come into markets which weren't there some time ago.
Okay, so you'd like to see a correction. Could we possibly put forward the proposition that we're seeing a rotation or a rolling bull market? So some of the stocks that had been the outperformers are now being subjected to a little bit of profit taking, maybe not correction. And we've moved on to this different phase of the rally, be it in the commodity space and industrials in the US, and that kind of might need to exhaust itself before markets really at an index level start to retreat. What do you think about that?
Look, yeah, I think what you're saying, there's some logic to it, but there's also some risks in what you're talking about as well. For instance, the oil price, and your oil stocks, therefore, will do well. As oil goes above, the $90 level. If it gets to $100, I think there's some other that creates issues in itself. In particular, in inflation. As talking before about the fact that we're now in the talk about a no landing. One of the big things about a no landing, though, which can create issues in itself, is if you get inflation holding above that 3% level in the US, that is. So I think we just need to be cautious on all this. And nothing goes up in a straight line, and just because something pulls back doesn't mean that it's all over. If things are just orderly, and I know that markets aren't rational at times, etc., that can be a positive. And just seeing things come back, I don't think there's anything wrong with that. But I think that there's a different conversation going on now about interest rates cuts, how many, when, no landing, soft landing, and also there are risks, and you must always take into account those risks.
Have you been actively taking profits, or are you just sitting on some cash to put it to work when that correction arrives?
We've done a couple of things. So we have, to go back last month when I spoke to you, I flagged that we would be decreasing or exiting our bond positions. We have done that. So I think, again, given the conversation that we were seeing with respect to interest rate cuts, the risks in that market had elevated, and you look at a cash plus, you can get 6 to 6.5% in a cash plus fund, versus without the volatility that you have in bonds. So we are out of bonds, and that was completed about 2 weeks ago. The other thing is we have taken a little bit of money off the table in global equities. With that lag in Australian equities, we've just evened that underweight that we saw in Australia, where we have been underweight. We've just neutralised that to a neutral position in Australian equities, using some of that money that we've taken off the table in global equities. So we have put some money aside if there is a pullback. But look, this has been strong. It's been an unbelievable run.
It certainly has. Should the pullback come in the equity markets, where would you be looking to allocate some cash, or is it dependent upon which markets pull back the most, or which stocks do?
The areas we're still keen on are broadly the developed markets, and we would continue to allocate there. And selectively emerging markets. I know that you've seen a bounce in China, where I think that one of the problems in some markets, be it even the argument on small caps, a lot of people are saying buy small caps because of the lag. Easy to buy, difficult to get out, and you've got to get that timing on getting out. Whereas we think that the long-term growth story for areas like India and Mexico still is quite strong. So selectively in emerging markets, selectively in developed markets. I don't buy this argument that something has lagged and therefore it has to make up. And like as a lot of people were saying with the Magnificent Seven, there was another 493 stocks. So those other 493 have to gap up, so to speak. They have to be solid companies. They have to have strong earnings. Therefore with revenue growth. And the economy is still, we're not out of the woods.
No, indeed. So at the moment, apart from markets having rallied really hard, if I've understood you correctly, it's really much focused at the moment on inflation risks to the upside, which can continue to cause a sell-off in US Treasury markets if that 10-year continues to track up. That has multiple flow-on effects. So it's almost like, more than one factor that could take money off the table.
Yeah, so look, we've taken it a little bit, and we're still overweight risk-based assets, but we've just been cautious. And as I said earlier in our conversation, we haven't put our foot on the brake, but I've eased it back on the accelerator, and I think that's the wise thing to do. I'd love to see some sort of pullback, but things don't always go to the way you would like to see it.
Oh, absolutely. And that expression, markets can remain irrational longer than one can remain liquid. Now, Just switching to Jamie Dimon's letter to shareholders overnight, I'm sure that you probably have read some of it or at least had a glance. What caught my eye, apart from the big mega trends and the fact that he is ultimately a risk manager, so does like to point out, risks of interest rates going to 7 or 8%. One thing that tweaked my interest was his comments on credit markets and his concern that if there was a potential, private credit, I should say, private credit, and because this is a topic that you and I have discussed before, you flagged it as one that people need to be concerned about. Did you pick up on that comment, and do you have any thoughts around what Jamie said?
Well, spreads are narrowed. I think that's what he's been saying, and therefore again the risks have become elevated. And whilst we've been very cautious in this sector, we've got a spread of different styles in diversified credit, but it's also making sure that you're with the right exposures. There's a large difference in quality in each area, and I think that's what you've got to ensure, that you're taking a conservative approach to this, because and definitely being something which is pooled. I think people don't understand, if you're in a single loan, you have 100% downside if it defaults. So you've got to run this as we always say, on per asset class. We diversify amongst asset classes and within asset classes. I think that's the really important thing. But I think that's what Jamie Dimon's calling. And as he also said, that they've been modelling interest rate scenarios between 2% and 8%. So again, it's this uncertainty on inflation at this point in time.
Absolutely. The other thing that I remember, if I cast my mind back to last year, in terms of property exposure, again, have to be very selective. But what was interesting, BlackRock buying a apartment REIT in the US, which apparently was one of the very bombed out sectors. Do you think for some investors, certain aspects, apart from industrial and data centres, which has been all the go, is there anything yet that's tweaking your attention in terms of commercial property or anything else?
We think it's probably just still a little bit too early in areas like commercial. I know a lot of people are sort of feeling that the valuations that are going to come through at the 30th of June are going to be near the bottom. Someone else that I pay a lot of attention to has also said, but you're going to see refinancings occur in the second half of this year. And so therefore, have those revaluations, are they enough? So we've already seen a couple of big down steps. will the 30th of June valuations be enough? Especially if you're going to get refinancing, will that finance be able to be rolled over, or potentially one or two people where they've got debt, they might end up having equity. I don't think that's going to be in a majority of cases, but I still think that in some areas it's just a little bit too early.
And just bringing it very briefly back home, Will, and if you don't want to touch on the thorny subject of populist politics getting into the corporate sector, what do you think we're going to see in terms of the supermarkets histoire, which is, continues to drag on?
Yeah, so me to do a big exhale then. I don't like government getting involved in private enterprise. I think that's first of all a problem. But you need private enterprise to be strong, and I think there's been a lot of the Business Council of Australia has spoken out quite loudly in the last sort of 3 or 4 days. I think when it comes to the supermarkets, I've read parts of what's come out, and it's just it's the preliminary side of it at this point in time. But I'm cynical whether we're actually going to see prices down at the checkout. When we next go to the supermarket, I doubt it.